Hello and welcome to Market Sunrise. I'm Ramzan Karmali, live from Yahoo Finance's studios in London. It's Wednesday, 3rd December. Coming up on the show, Bitcoin rebounds to hit a 2-week high. Anthropic looks ready for what could be the biggest ever IPO. And President Trump gives his clearest hint about who he's picked to be the next Fed chair. So grab your coffee and let's own the morning. The first thing you need to know is that the biggest ever IPO could come as soon as next year with AI startup Anthropic. According to the Financial Times, it's tapped up law firm Wilson Sonsini as it races with fellow AI startup OpenAI to go public. It was founded in 2021 by former OpenAI staff, and Anthropic was recently valued at $183 billion. The next thing you need to know is that we're just over an hour away from receiving important labour market data. ADP private payrolls could influence the Fed's next move, with government data still delayed after the shutdown and no monthly non-farm payrolls report coming this week. The ADP report will serve as one of the last major labour market indicators ahead of the central bank's decision. And even though the US holiday shopping season kicked off to record online sales, underlying signs of economic fragility still remain, with consumer confidence falling again in November. The CME Fed Watch tool now believes there is an 87% chance of a rate cut next week. And the last thing you need to know is that President Trump gave his clearest indication for his next choice of Fed chair. Even though he said he would nominate until early 2026, Trump signaled he might just nominate his top economic advisor, Kevin Hassett, to replace Jerome Powell.
And I guess a potential Fed chair is here too. I don't know. Are we allowed to say that? Potential. He's a respected person, that I can tell you. Thank you, Kevin. I want to thank you all for being here. It's a great group.
Bitcoin is extending its bounce from yesterday and hit a 2-week high earlier. At one point, it was trading just below $94,000. Crypto investors are looking for signs that the wider crypto market may be regaining its footing after a prolonged sell-off. Remember, since Bitcoin hit that high of over $126,000 in October, more than $1 trillion has been wiped off the value of the crypto market. And the president and his family have not been sheltered from the sell-off. Shares in American Bitcoin, the miner backed by Donald Trump Jr. and Eric Trump, lost almost 2/5 of their value on Tuesday. And according to Bloomberg, World Liberty Financial, co-founded by the president and his sons, has seen its WLFI token tumble over 50% from its peak in September. One company at the heart of Bitcoin is Strategy. Yesterday, it revealed a new $1.4 billion reserve to help meet its short-term obligations. Its CEO, Phong Le, explained to my colleague Julie Hyman just why.
We have a Bitcoin reserve for the purpose of the long term of the business. And now we've built a US dollar reserve for the purpose of the short term of the business. We don't want to be in a position to sell Bitcoin, but below 1x MNAV, it doesn't make sense for us to issue equity to pay off our dividends. We built up $1.44 billion. We will target 2+ years of cash reserves, if you will, US dollar reserves, so we don't have to sell Bitcoin. Let's say that gets us to 3 years. If there is literally a 3-year sustained Bitcoin down cycle, a 3-year sustained cycle where MNAV trades below 1x, then we may have to sell Bitcoin. At this point in time, it's the end of 2025. We're talking about 2029 where that may be the case. And we have the Bitcoin for a reason, to protect the company, to protect our shareholders. And if we have to sell it, we will.
And the cash that you all put into this reserve, this $1.4 billion reserve, is the cash that you have raised from selling shares, correct?
That's correct. It's from selling equity at a premium to MNAV, which by definition is accretive to our shareholders.
And of course, you have now embarked on a more recent strategy where you have been issuing various types of preferred shares and getting cash from that. They're sort of more credit-like instruments. We've talked to Executive Chairman Michael Saylor about that. What is sort of your capital raising plan for the rest of this year and going into 2026 when it comes to selling either the common equity or more types of this preferred equity?
Yeah, our preference is to increase our amplification by selling more preferred equity. We really just started this in January this year, and the idea of a perpetual preferred to buy Bitcoin is a pretty novel idea. Look, it's as novel as in 2020 when we said we were going to become the first Bitcoin treasury company. It took, I would say, about a year for people to understand what we were doing. Then we layered debt on top of that, and we became a Bitcoin treasury company that leveraged ourselves. And that took people a year, 18, 24 months to figure that out. And now we're issuing perpetual preferred, which we think is superior for a variety of reasons to traditional debt, to convertible debt. It's going to take 18, 24 months for the market to figure this out. But it's not just the market understanding what MSTR is doing. It's the market understanding that a perpetual preferred instrument that pays 10 and now three quarters a point, that's STRC, is better than other alternative things that you might be able to invest in. So it's going to take a while to season the market. Could be a year, 2 years, 3 years. At that point in time, I think we'll be able to really grow a lot of capital through our perpetual preferreds. The big challenge people had with them was how we're going to pay the dividends in the short term if we see volatility in Bitcoin, volatility in MSTR. Now we've created this US dollar reserve to address that challenge.
I'm also curious when it comes to your Bitcoin buying strategy. You guys have pretty consistently bought that Bitcoin, and it seemed pretty price agnostic. Is there any thought of going forward? I mean, listen, everybody says it's tough to time the market. I get it. But buying lower is better than buying higher as a general rule of thumb. So is there any sort of plan going forward to try to maybe not buy more on the higher side and more buy? I mean, I think that your average cost to purchase at this point is above where the price of Bitcoin is right now, if I'm not mistaken.
Yeah, I split buyers into sophisticated buyers into two categories. You have investors and you have traders. Traders are PhDs working at hedge funds who have, large desks with 4 screens in front of them, and they're making decisions at the millisecond level of when to buy and sell Bitcoin or buy and sell equities or derivatives, et cetera. That's not us. We're investors. And when you see an asset class like Bitcoin and you believe in it, you just buy it when you're able to raise capital to buy it. And that's our strategy, right? We are not Bitcoin traders. We're Bitcoin investors. And that's the distinction there. I'm pretty sure that if I tried to become a Bitcoin trader, I would lose to more sophisticated Bitcoin traders. So we just buy when we have excess capital or when we're able to raise capital.
We're heading for a short break now, but when we're back, we'll keep the focus on Bitcoin, but this time with a closer look at ETFs linked to them. Welcome back. So the SEC has issued a flurry of warning letters to some of the country's most prolific providers of high-octane exchange-traded funds, effectively blocking the introduction of products designed to deliver 2 or 3 times the daily returns of stocks, commodities, and cryptocurrencies. Well, Jared Blickery has more on the subject with Stocks in Translation.
What happens when you stack leverage on top of leverage in the crypto market? In a nutshell, well, that is the simple question that we're seeking to answer on today's Stocks in Translation, which has some slightly complicated answers. So as we dig into the shadowy world of leverage ETFs, buckle up, but we're going to guide you along step by step. So let's begin with a chart to illustrate how leverage can hurt on the way down. Here we have iShares Bitcoin, IBIT, as our Bitcoin proxy, and we also have Strategy. That's over the course of this entire year. Because of its huge Bitcoin reserve, which it funds with sales of stocks and other securities, Strategy has become a high-octane bet on Bitcoin. And if you look closely, you can see that Bitcoin peaked in October, but Strategy peaked long before that in July, and it's down 65% from there. And while our Bitcoin ETF is down about 5% year to date, Strategy is off closer to 40%. Now let's add one more layer of octane. We're going to take MSTR versus its 2X cousin, and this is Defiance Daily Target 2X Long ETF, ticker MSTX, and there are others. I'll break down leverage ETFs in a minute, but all you need to notice here is that if MSTR looks bad, its leverage version looks absolutely brutal in downturns. Leverage bets on strategy are down over 80% this year alone, with $1.5 billion in assets evaporating recently. So what exactly are people buying here? Leverage ETFs are exchange-traded funds built to track 2 times or 3 times the daily moves of a stock or an index using swaps or options. The key word here is daily. These funds are reset every single day. They're not promising 2 or 3 times the return of a stock over 6 months or a year. They're aiming for 2 or 3 times whatever happens between today's close and tomorrow's close. And that's where the trouble starts for many. Let's run through some of the pros first, because there are legit uses for these funds. Leverage ETFs can amplify short-term views. If you think a stock is going to pop over the next few days, you can use less cash to make that bet. And they can be very useful to experienced traders who understand the toolkit and they watch their positions closely. But on the flip side, these funds track daily, not long-term returns. That means that the path matters as much as the destination. Big up and down swings, they can erode gains over time, even if the stock eventually gets back to where it started. They're not designed as buy and hold investments. So if you hold them through a lot of volatility, the math, it can work against you very quickly. So where does that leave us? Here's what to keep an eye on. First, pay attention to Bitcoin price and volatility. These products live and die on big daily moves. If crypto volatility stays elevated, the math inside leverage funds stays a bit rough. Second, for MSTR, the pros watch what's called the premium or the discount to its Bitcoin stash. You don't necessarily need to understand it if you can read a chart of MSTR and Bitcoin itself. Just ask yourself, is MSTR leading or is it lagging Bitcoin, and in which direction? Study the charts of what's happened historically. Third, you can watch Bitcoin and related ETF flows. If money starts rushing back into plain vanilla Bitcoin products, that could take off some of the pressure from these leverage sideshows. If flows keep chasing leverage instead, the risk is going to remain elevated. Fourth is kind of big picture, but you might want to keep an eye out on new single stock leverage ETF launches. This is where the systemic risk question lurks. Right now, these funds are still a small slice of the overall market, so they probably aren't an immediate threat to market integrity, as it's called. But as more single stock products launch on thinner, more volatile names, their footprint in the plumbing of the market, it grows. And that's something that investors and regulators are going to want to keep an eye on long term. Bottom line, leverage ETFs are powerful tools inside the right hands for short periods. They can do a specific job. In the wrong hands, over too much time, they can turn a plain vanilla loss into a life-changing wipeout. And tune in to Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts. Stay tuned for more market.
Okay, time now for another quick break. But next up, we'll have today's trending stocks, including the latest on American Eagle. Stay tuned. Time now to look at the stocks that are trending before the bell rings on Wall Street, and we're seeing some big moves across tech, retail and aerospace. Well, let's start with American Eagle. That's just reported earnings overnight, and clearly the targeting of teen consumers through viral social media campaigns with the likes of Travis Kelce and Sydney Sweeney is working. Earnings per share were at 53 cents and revenues came in higher than expected at $1.36 billion for the quarter that ended in October. The retailer reported solid holiday season guidance and strong guidance, and investors are doubling down on the outfitter stock, which has doubled in 6 months. Next up, Marvel. Now, we told you yesterday morning that this was one to watch, as it has reached an agreement to acquire Celestial AI. And today's moves following Marvel's earnings confirm that the chip designer is only gaining prominence. Shares are up more than 10% in pre-market, as you can see, for a stock that's staging a comeback after a very difficult start of the year. The lift comes after a bullish outlook on data center and AI-related business. Like we told you yesterday, it's driven by strong demand for custom chips and photonics. Remember, these are microchips that use photons or light instead of electrons to carry high-speed information into our electronics. Staying with artificial intelligence, and SoftBank, the major investor in OpenAI, well, it soared in Tokyo as the group pushes deeper into the AI chip ecosystem after acquiring more major stakes in the sector. Japan's giant tech conglomerate has taken on a revised strategy and is doubling down on infrastructure. On to CrowdStrike, a bit more of a mixed picture here. Shares of the cybersecurity specialist were down around 2% in pre-market trading this morning, now just over down 1.3%, even if CRWD's third quarter results narrowly beat estimates. Revenue for the quarter came in at $1.23 billion, which was slightly ahead of the $1.21 billion expected by analysts. Earnings per share of 96 cents also slightly just beat those estimates. And CrowdStrike lifted its guidance for the year, but visibly investors were hoping for a stronger beat. Now, a couple of stocks in Europe before we go. Shares of Zara owner Inditex, well, they jumped 8% after the Madrid-listed retail company reported strong results. Now, Inditex, whose brands also include Massimo Dutti and Bershka, reported 4.9% growth in third quarter sales to 9.8 billion euros. It's enjoyed some analyst upgrades in recent days, and importantly, it's an indicator of consumer sentiment and habits. And between Inditex and American Eagle, we are seeing some pretty positive signs. And finally, Airbus, which is doing a bit of a reset after software and fuselage issues. The Boeing rival is bouncing back today, up more than 3% after clarifying its strategy to solve recent challenges and after slightly revising down its delivery targets. Now, if you own gold or silver, you certainly noticed. Long gone are the days where commodities were stable stores of value. This year, they've kept rising and rising. So what does this all mean for the jewellery industry? Well, my colleague Julie Hyman spoke to J.K. Simonsick, CEO of Signet Jewelers.
On the tariff front, we've done everything from navigate countries of origin, pulled some production in the U.S. We've leveraged some supply chain efficiencies to really not only mitigate any of the headwinds that might come from it, but also, maybe more importantly, to preserve the value proposition for our customers. We've got a big, broad set of brands in our portfolio that really cover the gambit of a lot of focus on the middle, and I think making sure that we safeguard that value is one of the most important things for us. As far as gold's concerned, we're in uncharted waters. What I would tell you is historically and even to date, we've seen that customers understand the commodity value of gold, and as we pass through any commodity cost changes, while it may impact how we think about design or may impact even some unit velocity, we find that customers understand that value proposition and are supportive, particularly as we think about how do we position ourselves relative to the competitive landscape to still leverage our scale and deliver value for them. Silver, to a lesser degree, I think we're seeing some renewed interest in silver, in part because of some of the higher cost of gold. And even as we go into this holiday, we've got brands like Zales that are leaning into key items. 1 carat sterling silver, lab-grown tennis bracelets, sub $500. We really see that as an opportunity to help drive stronger value propositions for customers and be there at key price points.
JK, help an older guy such as myself that is unmarried. Why do sub 30-year-olds love lab-grown diamonds today? Is it just a price thing? What am I missing?
Yeah, I think it's, I think the important, narrative to keep in mind around diamonds is that there really is a love for both, and there is an opportunity for growth in both lab-grown and natural. For us, it is more, I guess, noteworthy at lower price points. In particular, on the engagement side of things, Brian, when you talk about sub $2,000, this is an emotional purchase, and it's all about maximizing emotional value. And if you're budget constrained, then in particular, the the cost benefit of lab grown in those lower price points is something that resonates more. Maybe more importantly for our business, the fashion opportunities around lab grown diamonds are really what we get a little more excited about. I'll stick with the example of the tennis bracelet that I just talked about. To be able to hit more approachable price points where that can become a part of my fashion proposition every day, particularly in a world that's driven off of stacking as a trend. That really does open up an item like a diamond tennis bracelet to a broader set of customers overall and makes it more approachable. Lab also, because you're not dealing with yield loss and some of the scarcity that are involved with natural, which are unique, beautiful, and special, it really does give you some degrees of freedom around design. So, we see it as an opportunity for continued growth on both sides of the business, and generally within our portfolio, the more you move up in average unit retail or income demographic, the more that customer is going to lean towards and appreciate the beauty and allure of a natural diamond over all else. And the more you look at a budget-constrained customer or someone who's looking for everyday fashion, I think the more relevant lab-grown diamond fashion is, and the more that comes into play in our mix.
Some breaking news now. We have some Q3 earnings that have just dropped. First up, Macy's. Now, it's just reported its strongest growth in 3 years. But as you can see, shares are down over 3%, even though it handily beat Wall Street forecasts and raised its guidance for the rest of the fiscal year, which shows that consumers are still spending despite their economic concerns. Now, the retailer also boosted its full-year guidance for adjusted earnings per share to as much as $2.20. Back in September, it guided for that figure to be just $2.05. Now, the reason the shares are down so strongly, though, it could be because of warnings it's made about this current holiday period due to consumer pressures, and also they talk about tariffs as well. So that's definitely one to watch today. Next up, Dollar Tree. Now, it has boosted its adjusted earnings per share guidance for the full year. And in fact, the guidance beat the average analyst estimates quite handily. It's also reported comparable sales for the third quarter of $4.75 billion. That beat the street call of $4.7 billion. And as you can see, shares are up over 1% in the pre-market. Okay, let's go and check in on the markets before we go. Let's check in on Asia to begin with, and the tech-heavy indexes in Japan and South Korea both rose by over 1%, but as you can see, Hong Kong's Hang Seng fell sharply. It was a bad day for mainland Chinese stocks too. Perhaps some profit taking, but investors here are waiting for clearer signs, not just from the Fed, but also the Bank of Japan about future policy. Europe now, and stocks seem to be lacking clear direction, though defense stocks are in the region are higher today. Let's have a look on to how Wall Street might open, and US futures are higher this morning. They look poised to maintain momentum on a modest rebound with that jobs data I talked about on deck to help set interest rate expectations ahead of the Fed's policy meeting. Okay, that is it for Market Sunrise for this morning. Stay with Yahoo Finance for continuing live coverage of the markets and your money all day on streaming and online. I'm Ramzan Karmali. Go own the morning.